nominally speaking, have stopped going down. They're now headed higher. The dollar has been extremely strong in DC, supposedly cutting out waste and fraud and abuse. So that's also very positive for our fiscal agenda going forward. So that should be negative to gold. So it just bothers me a lot that gold just can't go down. Have you noticed lately that the dollar goes up, gold goes up, interest rates go up, gold goes up? No matter what happens, peace breaks out in the Middle East and in Russia and Ukraine, and gold goes up.
Interest rates have stopped declining and are now rising, while the US dollar remains strong. Efforts to cut waste and fraud in government spending should support fiscal stability, which would typically be negative for gold. However, gold continues to rise regardless of economic or geopolitical events, even when traditional factors suggest it should decline. Michael Pento, an investment strategist and economist, explains that the key to managing money effectively is understanding the second derivative of inflation about economic growth. The massive liquidity injected into the system during COVID is still being absorbed, with reserves in the banking system exceeding $3 trillion, far higher than pre-2008 levels. While inflation has severely impacted the bottom 60% of consumers, the wealthiest 20% remain financially strong due to resilient stock and real estate markets, keeping the economy afloat. Despite market stability, stocks are highly overvalued based on metrics like total market cap to GDP, price-to-sales ratios, and negative risk premiums. With Treasury yields offering better returns than stock earnings yields, the upside for equities appears limited. While an imminent crash may not be likely, there's little room for further market growth, making short-term bonds an attractive investment option. Michael Pento highlights that the excess reserves in the reverse repo facility have already flowed into the Treasury market and economy. In 2019, a repo crisis occurred when reserves fell to around $2 trillion, prompting massive money printing during COVID-19, which pushed reserves up to nearly $5 trillion. They have declined to about $3.3 trillion, but it's uncertain how much further Powell will allow them to fall. While a reserve shortage may become an issue in a year or two, a more immediate concern is a potential funding problem in the Treasury market, which could trigger a spike in long-term yields. Since the Fed doesn't directly control these rates, such a spike could catalyze the next liquidity crisis. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
Concept to grasp when managing money, in my humble opinion, is the second derivative of inflation in the context of growth. And I believe the $5 trillion that was printed over a COVID disaster, it's just taking a long time to come out of the system. So I'll give you an example of what I'm talking about. So we talked about the reverse repo facility that was at once $2.5 trillion in the summer of 22. It's now down to just a couple of dozen $1 billion. So that's out of the system. But there's still about $700 billion in the Treasury general account. That's liquidity out there. And then I was looking at the reserves in the system, the reserves in the banking system. There's a tremendous amount of reserves out there. There's over $3 trillion in reserves. And you think about put that in context, Mr. Pento. What does $3 trillion in reserves look like, historically speaking? Well, if you look at prior to the global financial crisis, there was like nothing. There was like $50 billion of reserves in the system. And now there's over $3 trillion. So you ask yourself, well, what's going on in the economy? What's going on in the markets? Well, what's going on in the economy is that the lower three quintiles of consumers, so the bottom 60%, are decimated. They're wiped out. Inflation has crushed them. That's why defaults and delinquencies are a 5-year high. But then you look at the top two quintiles, especially the top quintile, and they're doing great. They've never been better. Their houses haven't gone down yet, and their real estate portfolio is fantastic, and their stock portfolio is doing great, and that's keeping the economy running, moving just nicely. But as I said, the inflation has wiped out at least the bottom 3 or 4 quintiles. This really hurt them the most. So you have all this liquidity out there, which is boosting markets and keeping the top 20% healthy and paddling along very vigorously. So here's what I think is going to happen. And let me say parenthetically that I am not yet short the market, but the market is so expensive now that even though it's not going to crash imminently, there's just not a lot of room for it to go higher. So if you look at things like the total market cap of equities to GDP, or the price to sales, the S&P 500, or the median PE ratio, the Cape-Shiller 20-year inflation-adjusted PE ratio. If you look at things like risk premiums, which are negative now, so you take the inverse of the PE ratio and you subtract something like a treasury from that metric, and you say, wait a second, I get paid more to just own T-bills than I do with the earnings yield on stocks. That's very, very rare, Dunnigan. No, the reserves in the system are so there's the reverse repo facility, which is the excess reserves was parked at the Fed. That's gone. That went into the treasury complex, and that went into the economy. So when you look at 2019, when we had a repo crisis, that's when the reserves went to around $2 trillion. And that caused the repo crisis. So that's when they printed, we went all the way up. Okay, so it was the repo crisis, then COVID happened right after that. We were headed for a recession anyway. They printed trillions, like I said, $5 trillion, and the reserves went up through the roof. I think they went to $5 trillion. Now they're back. Now they're down to 3.3. My numbers might be slightly off, but they're not them. But you get the idea. So we know that the level of reserves can't go to $2 trillion, but what will Powell allow them to go down to? I don't know. But that's going to be a problem maybe a year or so from now.
Michael Pento points out that gold remains near record highs despite factors that traditionally weigh it down, such as rising interest rates, a strong dollar, and increasing focus on Bitcoin. Additionally, geopolitical tensions appear to be easing, with talks of peace in Ukraine and Gaza, and the U.S. government is supposedly addressing waste and fraud, which should support fiscal stability, ordinarily negative for gold. However, gold continues to rise regardless of these influences, raising questions about what drives its price. Michael Pento discusses various theories. One theory suggests that the U.S. government may be secretly accumulating gold to cover potential shortfalls in its reported reserves. If the 261 million ounces of gold held by the U.S. Treasury have been loaned out, hypothecated, or otherwise unavailable, a new administration focused on audits could uncover the discrepancy. The government might be scrambling to replenish its gold holdings to prevent this quietly. This theory could explain why gold remains strong despite economic conditions that typically push it lower. Now let's redirect our attention towards the interview.
There's a lot of reasons why gold should not be at record highs. We keep bouncing our nose against $3,000 an ounce. And you think about it, well, we're talking about interest rates. Well, interest rates, nominally speaking, have stopped going down. They're now headed higher. The dollar has been extremely strong. Bitcoin, there's an obsessive compulsive nature in the media and even in the administration about Bitcoin. I don't understand it, but that's stealing a lot of gold's thunder. Peace is supposedly breaking out all over the world, right? Ukraine, Russia, Gaza. Well, thank God for that. I hope it's true. You have the Doge boys, or actually it's just now one, in DC supposedly cutting out waste and fraud and abuse. So that's also very positive for our fiscal agenda going forward. So that should be negative to gold. So it just bothers me a lot that gold just can't go down. Have you noticed lately that the dollar goes up, gold goes up, interest rates go up, gold goes up? No matter what happens, peace breaks out in the Middle East and in Russia and Ukraine, and gold goes up. Well, why is that? And I have a theory. I don't know if it's really. I have a theory that something's going on, and I've heard stories about a lot of gold coming into this country from overseas. Here's a theory for you, and it's not mine. I didn't come up with it myself, but I've used my 34 years of experience in this business to analyze it. And I kind of believe it might have some credence. What if, Donegan, the Treasury's 261 million ounces of gold that they say they have isn't really there? And you have a new sheriff in town who's prone to doing a lot of audits of things like the Fed, maybe even the audit of the Treasury. What if they're scrambling? What if they, being the United States government now, is scrambling to buy gold to replace what they've already loaned out or hypothecated or never had, those 261 million ounces of gold? That makes some sense to me. Because there's something else going on. It isn't a recession. It isn't a crashing dollar. It isn't a crashing economy. It isn't a crashing stock market. It isn't falling, plunging real interest rates. What is it? Why is gold where it is? You could explain some of it with inflation, but I think there's something else going on there, and I think what I've just mentioned could be a reason.
The financial landscape is experiencing unusual dynamics, with gold defying traditional market forces, excess liquidity still present in the system, and concerns about potential funding issues in the Treasury market. While markets remain stable for now, rising long-term yields and overvalued equities suggest increased risks ahead. Investors should remain cautious and consider alternative strategies to navigate these uncertain conditions. If the U.S. government is quietly accumulating gold, how could this impact future gold prices and market confidence? How might a spike in long-term Treasury yields influence overall market liquidity and economic stability? Share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.